that's really the setup. Let's pull up our own gift nifty. There you go, the implied open on your screen. A marginal uptake on the back of the move that we saw yesterday. Mind you, very range-bound day of trade yesterday. But let's stick with global for just a few minutes. Let me bring on board Ed Yardeni of Yardeni Research this morning to give us a perspective as to how he's seeing the moves. Ed, it's great having you, and give us a perspective. Let's first talk about the US 10-year bond and even the 30-year for that matter following suit. This flip-flop from a 4.7 to 4.63 and now back to 4.7. How are you reading the moves at this point of time?
Well, I know a lot of people are getting very concerned. I'm not that concerned because I've been thinking since the beginning of the year that the 10-year Treasury bond yield would be range-bound between 4% and 5%. That's quite a broad range, but I think on average we'll see it around 4.5%. So we're really still very much in the range. I view bond yields as being back to normal. This is where bond yields were before the great financial crisis. The great abnormal environment was between the great financial crisis and the great virus crisis, when the Federal Reserve basically rigged the bond market by keeping interest rates extremely low. So I think the bond markets, to a large extent, reflect a healthy economy. So I'm not particularly concerned, but then again, I have to be concerned because there's lots of chatter about this issue. I'm thinking that, yes, we certainly have a deficit problem, but we've had it for a long time. And I'm thinking that the Treasury's actions here probably mean that they're going to be issuing more Treasury bills, which will also take some pressure off the bond market.
Ed, do you think the bigger concern is the way the Japanese 10-year paper is actually moving? I mean, these are levels last seen in 1996, right. And people are wondering now if the BOJ does hike by September, what happens then?
Well, I think you bring up a very important point, a very good point, and that is we can't just focus on the U.S. bond market. The bond market has gone global. What happens in Japan clearly has an impact on yields around the world, and you're quite right. We've seen that in response to weakening yen, both the Japanese Ministry of Finance and the US Treasury got together and tried to support the yen, and clearly the US Treasury's involvement had to do with they just don't want the Japanese to have to sell Treasury bonds to support the yen. So I think that kind of got everybody rattled a week or so ago, and now everybody's rattled over the fact that the Treasury debt has reached a nice round number, not so nice round number of $40 trillion. But again, we've seen large deficits and lots of debt for quite some time without getting up to bond yields that would hurt the U.S. economy. And I think that's still likely to be the case.
So, Ed, I mean, at a time when you've got the U.S. long yields and the Japanese bond yields just pulling money away from each other, what should investors be doing? Hide in cash, increase allocation to AI, buy protection in gold?
Maybe all of the above. Having a diversified portfolio in a period of a lot of uncertainty is always a wise thing to do. But I think we're still in a global bull market in stocks. I mean, we're near record highs of about a week or two ago in most stock markets around the world. So I don't think that one has to panic here and sell stock positions. I think bonds at these levels are really quite attractive, actually. And then with regards to gold, yeah, gold looks like it made an intermediate term base. It found a lot of support at 4,000. Looks like we got a lot of the fast money out of the gold market, and now it looks as though it's doing better. And that's partly because of the concerns about the U.S. Deficit, about the possibility of still higher inflation. But all in all, I think stocks, bonds, and gold still make sense in this kind of environment.
Okay. And Ed, just last off, how do you allocate and how do you see India in this and the impact of all of this on India? What's the view there?
Yeah. Well, India had a really good bull market a couple of years ago, and it's been basically consolidating ever since. It's still a relatively expensive market, but I think once the price of oil settles down, and maybe that's wishful thinking, maybe it's not going to settle down, but I think it will settle down. I think everybody's scrambling to figure out how to get oil out of the Middle East, particularly around the Persian Gulf countries, out from other outlets. And I think that's happening and will continue to happen. So I think the price of oil, let's remember there was actually a bear market in the oil from 2022 to the beginning of this year. So there was plenty of oil around, and there still seems to be plenty around, because you would have thought that oil prices would have gone a lot higher. But I think India needs to, for India's stock market to do better, I think we need to see oil prices stabilize, hopefully at a lower level. I think there was some concerns that AI would be a serious disruption to India's IT industry, which has a lot of consulting and software companies. But I think that kind of concern will also ease off, and we'll find that the technology area will do better. And then the financials, I think, they've been good stocks over the years. I think they'll continue to be.
Ed, so good having you on the show and getting in all that insight. Good speaking with you.
Thank you. My pleasure.